Results from the 2023 Canadian First-Time Homebuyer Survey conducted by Royal LePage and Sagan were recently released. The key takeaway was related to concerns around having a sufficient down payment to purchase a home. Basically, the ability to purchase a home that they really wanted. Want to learn more about programs or options that may get you into a home sooner? Well, we're going to go a little deeper on the topic of pre-approval and then talk about possibilities currently available to home buyers. Understanding the components and supports associated with the pre-approval process will help prepare you as a home buyer for next steps. This information, coupled with the knowledge about finance options such as shared equity, ownership, and rent to own, helps to provide a big picture view of available possibilities. Lorne Andrews, principal broker with Dominion Lending Center's Expert Financial, is here with me again today to go through those steps. So Lorne, during the last episode, you identified the 3 pillars of pre-approval. Let's do a deeper dive. Down payment was the first pillar, and it seems to be the greatest challenge for many home buyers, in particular first-time home buyers. Tell us a little bit more.
So, the market's changed, or it's evolved or grown over the last few years, and where you could, the price point that you could buy a home, 10 years ago is a lot different than it is today. Okay. The demand is surging. We have influx of, immigration coming into the country which has put a demand on the supply, and the supply chain hasn't really been keeping up, which is definitely starting to push property values up, which is, why a lot of people want to get in as soon as possible, right? Because they know it's an appreciating value. If they can get into real estate today, they're going to start building their net worth through owning real estate. And then, even if it's in stages of every 3-4 years to sell the home, buy the next one, sell the home, buy the next one, building up equity and then taking those stepping stones to, gradually get your way up there, right? But down payment's always been a challenge, because especially where price points are and everything right now. So I think it's probably important to understand, because, one of the questions people would ask is, what do I need? How much of a down payment do you need when you buy a house, right? And there's some people on, that might be listening to this, they say, I already know this, but there's people that might not be. So I think it's worthwhile explaining it all over again. Okay. So when you're buying a home, there's sort of, I like to say there's a cutoff category at $1 million. Okay. So anything under $1 million, is what's called insured or an insurable mortgage. Okay. Potentially. And the next part is, how much of my down payment am I putting down? Is it 20% or more, or is it less than 20%? Okay. So where a lot of people are getting into the home, not everybody has a full 20% to put down on a home. Okay. So the question is, can I buy a home with less than 20%? I do get the question. Like, there's some people that think you need 20% to purchase a home. So again, you only need 20% to purchase a home if you're buying a home that's over $1 million. Okay. Anything over $1 million, you need 20% down payment. When your home is less than $1 million, the criteria, it becomes an insured mortgage if it's less than 20%. And insured mortgage just basically means the banks will pay the insurers, which are CMHC, Sagan, or Canada Guarantee, an insurance premium, okay, on your behalf. So you don't have to come up with that cash. They're just going to add it into the mortgage. That insurance premium is really just for the protection of the lenders, the banks themselves, right? Because if there's ever a default, they are covered, right? So when you get interest rates, and this is often, this is kind of a sidebar, because I have a lot of people who will call me and say, I saw this rate out there, but rates are always different depending on the amount of down payment you have, et cetera. So if you have less than 20% down, okay, your rates are better than if you have more than 20% down. And people shake their head and say, well, why am I paying a higher rate if I had 20? Shouldn't I be rewarded? I said, no, because it's an insured rate. There's a protection to that rate, so that banks give it at a better premium is basically the best way to explain it. There's other nuances, but that's really the best way to understand is why those rates are different. So you're getting a little bit of a lower rate, but you have this insurance premium gets put into the mortgage, and then it's amortized, may change your payments by $30, $40 per month, but it gets paid into the mortgage. So how much of a down payment do I need? So if I'm buying anything up to $500,000, okay, I need a minimum of 5% of up to $500,000. So if I'm buying something for $500,000, I need $25,000 as my minimum down payment. Okay. The portion that goes over 500 up to $1 million, I need 10% of that portion. Okay. So if I'm buying something for 600,000, I would need my 25 up to 500, and then that 100,000, I need 10% of that. So that's 10,000. So 35,000 would be my minimum down payment if I'm buying something for 600,000, for example. Okay. And 45,000 if it was 700,000, that sort of thing. So the other thing when you're qualifying for those sort of mortgages, the maximum amortization or the term that you can have is 25 years. Okay. So where does this down payment come from? Okay. So let's slide back to where's the sources. So obviously your savings, okay, things, anything you can save over time. Okay. Where are other sources of down payments coming from right now? A lot I see from family members helping other family members with gifted down payment. Okay. So with a gifted down payment, the lenders will allow this as long as you're going to be living in the property that's owner occupied. They will allow a family member, an immediate family member, to give you a gift. Okay. And the gifts, usually every lender has their own gift letter that's signed saying this is a gift and it's non-repayable. And the reason why they ask that's non-repayable, they want to make sure it's not borrowed funds, that it's not a debt that you have to put in liabilities, etc. Okay. That said, there are lenders out there that will allow you to borrow the down payment. Okay. And that's called flex mortgages. It's really called. It's basically, hey, no, we can borrow the down payment from line of credit or other sources. We just have to put the debt into your liabilities and make sure it all works out. So there are lenders out there that do allow you to borrow down payment. We don't get a lot of borrowed down payment just because it lowers what you qualify for, right? So we don't see a lot of that these days, but there are a few lenders that do allow it. Where I've seen more and more is you have parents, grandparents that don't have mortgages on their home because they've paid it off over years. They'd like to help their kids or grandkids, okay? But if I'm the grandparents, like, man, how do I help my grandkid without having to sell my house, okay? And then cash out and say, here's $50,000, you can go buy your home, and now I have to go somewhere else. Or having to take a mortgage on again where I have to make payments again, and because I work so hard just so I don't have to make payments. And what's happening there is a lot of those people are taking reverse mortgages, right, okay, to use that as the gift that they can give for that down payment. And the advantage of a reverse mortgage is there's no mortgage payments that they have to make for them. It's just accumulated over time. And when they sell the house, you pay it off. So I see a lot more reverse mortgages being used for down payment nowadays. Okay. Other things, RSPs. So you can contribute to your RSPs. Okay. So basically, you have an income and you contribute, let's say it's $5,000, you contribute to your RSP. So it has to be in your RSP for 90 days. And I can use that as down payment. You can use up to $35,000 from your RSPs. And the advantage too is whatever contribution I'm making to that RSP now serves as a tax deduction. So if I've been paying taxes, all of a sudden drops my income by $5,000, I get a tax rebate. Okay. So scenario on this. So I'll tell you another way this person used it. I had somebody that was living in their basement. Okay. They're 35 years old. And they said, Lorne, I've had enough of my parents. I gotta get out of their basement, right? I said, okay, what do you have for down payment? They said, I have maybe $6,000, $7,000. And they wanted to buy a $500,000 condo. Okay. So we know the minimum down payment is 5% and they need $25,000. So, and this is like January time. So how do you turn $6,000 into $25,000, right? So what she did is we looked at the strategy. It says, okay, let's maximize your RSPs right now. Okay. So she had a line of credit that the bank had given her. So she had drawn from the line of credit, I think $30,000 from the line of credit, and used that as a contribution to her RSP. So now she has $30,000 plus her $5,000 that she saved, and she got a big tax refund. Like it was like $12,000 or whatever it was when the tax came. So she took that $12,000, paid down the loan. Okay, but then her ratios are still over because we have liability in there. She has that loan, right? And then all we did is we just did a cashback mortgage when she bought it. So they gave her 3% cash back, and she paid off the rest of the loan, which qualified her. And then she got her condo within 6 months from having only $6,000 saved, right? So it's brilliant. It's just a matter of, okay, where do we want to get to? What can we leverage? What other programs we can leverage? And with that program, the government's just created what's called a first-time home buyers basically savings account. That's really what it is. And that works almost the same as the RSP. So if I can put up to $8,000 per year in that account. So if anything I put into that account, I get my tax refund. So I get a tax rebate. Okay. And then when I buy the home, I can use everything I have in that as my down payment. So I can use a combination of my RSP and this. Okay. The difference here is if I use my RSPs for purchasing a home, Nicole, I have to pay that back over 15 years. Okay. The other one, the home savings account, I don't have to pay it back, right? So it's just, nope, I can use it towards buying a home and I don't have to pay that one back, right? So that's kind of the difference, but it has the same effect on your income. As soon as I make a deposit to either one, it's going to reduce my income. Okay, so it gives me that rebate, tax refund, things like that. So I can use that. Rarely now I've seen so I've actually encountered this once where I had somebody whose parents bought them a life insurance policy when they were young. Okay, because it's a whole life policy, and when you have a whole life policy, there's a value to it. So you can actually borrow against that value. Okay. And so you're not cashing in the life insurance, you're just borrowing against that value and use that as, down payment portion as well. Okay. And with that, there's also some other programs. There's the government has, if you pay 5%, they'll give you 5% towards the down payment as well. Or if it's a new build, they'll give 10%. That kind of helps elevate your, down payment, portion as well. That particular program that the government runs is better on the outskirts of the GTA because there are some restrictions in the amount of income you can use and things like that. We look at it, but sometimes it's not always to your benefit to use that particular program. Sometimes you qualify for more by not using the program. So, because the mortgage to income restrictions that it has within it. And then other programs, which we'll probably dig into shortly, like shared equity financing, rent to own programs, things like that too. So there's all other ways that we can, there's so many different sources of down payment. And that's where it's so important when we connect with people, really understand where they're at, what they have access to, where their limitations are, and then start putting the pieces together.
I have one quick question with regard to down payment, and it's related to closing costs. How can closing costs impact the required down payment?
So that's a good question because a lot of people think, I'm going to buy this. I'm going to buy that $500,000 condo. I finally saved this $25,000. I'm going to go buy it. Wait a minute. There's closing costs. What do you mean there's closing costs, right? I thought it was 5%. Yeah, that's for your down payment. But there's other costs that are involved, obviously, when you're buying a home. Okay, so closing costs include things like land transfer taxes. So whenever a property changes hands, there's land transfer taxes, which get paid on that particular home. And calculating land transfer tax, you go to a calculator and you can put in the amount. It'll tell you exactly how much those land transfer taxes are going to be. If you're a first-time home buyer, you will get a rebate against those land transfer taxes, but it's only a portion of it, right? So It's usually about $2,000 per person, I think it is. So there's land, so there's those costs. But then who's going to do this transaction for you? What's going to be a real estate lawyer? So you have to pay real estate fees as well. And for a purchase, I think those are around $2,200. Think somewhere around there, maybe $2,400. Depends on the distribution. Depends on the lawyer, right? So, but it gives you a range. The lender, just to give you an idea what the lender's looking for, is they're looking for 1.5% of the purchase price to cover your closing costs. If you're buying in the city of Toronto, most of them want to see 3% of your purchase price. And why do they want to see 3% of that purchase price, Nicole? You want to tell everybody?
Not only do you pay the Ontario land transfer tax, you pay municipal land transfer tax in Toronto.
Yeah. So that's just the city of Toronto. So anything with an M area code, your closing cost is going to be high, right? And like I said, it could be, like if the border is Steeles, if you're on, the north side of Steeles, your closing cost is going to be a lot less if you're on the south side of Steeles, right? Because now you're in that Toronto municipality. So, probably like Nicole's equipped and we're all equipped with sort of buyer net sheets that kind of go through, okay, here's what you can expect for your, your closing costs. But the lender, they generalize. They say, listen, we want to see 1.5%. Will it always cost you 1.5%? No, not if I'm getting a rebate, things like that. Will it always cost 3% if I'm buying in Toronto? Not always. If I'm a first-time home buyer, I could get a rebate. But the lender generalizes. They say, show us 1.5%. That's the general rule of thumb when you're to cover the closing costs above and beyond what your down payment is.
So now that we have that elephant in the room handled, the down payment, why don't we talk about the next two pillars, income and credit, and how do they impact the mortgage approval process?
Let's talk about credit first. Okay, so credit is so important to be monitoring on a regular basis because I've seen preventable credit issues that have delayed people getting into a home. Okay. And it could be something like, I had an argument with Fido and I didn't want to pay them the $33.60 that they said I owed them. And they thought they were winning a battle, but then it gets put on the credit bureau. They got all these late payments. And then the lender's saying the credit score starts to decrease. And the thing is if your credit score is below, say, 680, okay, it reduces the amount that the lender will give you. Okay. So it's reducing your purchasing power. Okay. And if it goes below 620, most of them will say, sorry, we just can't finance this. Okay. And this is on the A side with A lenders. Okay. So credit is important to monitor. And I would say that the things that you got to look for, one is, advice, make sure you pay everything on time. Okay. So that is a major part of how credit scores are calculated. You also have to have multiple trade lines. Like I just had somebody call me and I asked them, how's their credit? And they said, perfect. Right. And I pulled it. They had no active trade lines because they said, yeah, I got rid of all of them because they wouldn't have to worry about any late payments. Well, there's nothing to evaluate you with if there's no active trade lines. And I had people say, yeah, I got all these credit cards I don't use and I've had them for years. I'm just going to start canceling them. It's like, oh, please no. Right. Because you have, let's say I got, this new credit card, for 3 months. I'm going to take this. I'm going to get rid of all those other ones and close them. You have all these ones that have accumulated years and years of scoring. Now you got a new credit card that's only 3 months reporting. Then all of a sudden your credit rate just plummets because it's just evaluating on the one now. So, credit, utilization is important as well. So if, for example, and what utilization basically means is I have a credit limit and whatever my balance is relative to that limit, the higher it gets closer to the limit, it's going to start pushing down my credit score. Okay. You want to try and have your balances below like 50% is a good idea of whatever your limits are. And I've had people that have had all of a sudden their credits have dropped. They had, let's say they had a $6,000 limit and they had a $5,500, balance. and it's pushing the credit score down, and the credit company sends you that letter and says, hey, would you like a credit increase? Well, we approved you for $12,000. As soon as they take that credit increase, their credit score jumps. Okay. And people say, oh, why would it jump? It's because you just increased the gap between what you owe and what the balance is. Okay. Now, if you're going to spend more money on it and decrease that gap because now you have a credit limit, then don't take that credit limit increase, right? It's just like there's other ways to do it if you can't manage it, right? But just to understand, that's another big factor is utilization. What's your, and I've had people where I've had to refinance where the credit score is low and it's like, man, I have to get into an alternate lender where it is. But if we just paid this off, so I'll do a quick loan, pay it all off, consolidate it, pull the bureau 30 days from now, it might have jumped, 80 basis points, and now I can get them a better term, just because it's just managing that. So utilization is really, really important, right? So credit. And the next part was, income, right?
Right on.
Right. Did I cover the credit okay?
You did. Okay,
perfect. All right. So income, so many different ways people are making money right now. You have independent contractors, you have people that are salaried, you have people on commission, you have different contract positions, you have new to Canada situations. There's so many different ways. And understand that depending on where that income's coming from will determine how we have to navigate that. Okay. So for example, anybody that's salaried or they're getting any type of bonuses with their salary, the A lenders, all the A space, the big banks or whatever, they're saying, hey, if you're using any bonuses, we need a 2-year average of that bonus. We can't add it on, just because you got it this year and you've only been there for a year. So those are the things, we look at. We look at, are you on probation, right? So for example, I just got this job. I'm getting paid, $80,000 a year. I want to go buy a house tomorrow. Are you still on probation? A lot of lenders will say, okay, you're still on probation. No, wait till you're off probation, then we'll look at it, right? And there are some lenders that'll say, okay, if you've been in the same industry for a while and it's a big company, we're willing to waive that probation, right? And it goes back to our first video. We talked about our first podcast where we talked about the different lenders, right? So it's just understanding, which lenders have these sort of policies. Also, sometimes I'm going through and I'm talking to individuals and ask them, do you have any children? And they say, yeah, I have children. And I ask them how old they are. And I am interested in the children and how old you are. So I understand that. But I also need to know because I need to know if maybe you're receiving child tax benefits, like other things that people forget. Oh, that's income. I can use that. Or it might lead to another conversation of, they're separated and they're getting maybe, child support or things like that, or they're paying child support, which I have to factor into liabilities, things like that. So those are all sources of income. When you're dealing with a lot of people that are business for self, there's more and more people out there. And when you're business for self, you tend to not declare as much money, because you just don't want to pay taxes, right? So it's like, make X and you try and deduct all your deductions and then you have your net. Well, understand the banks will use your 2-year average of your net and maybe gross it up a little bit as well. So sometimes that's not good enough, right? And so we might go to what's called an alternate lender, I like to call it alt A lender that has different policies when it has to do with self-employed people. And what they'll do is they say, you know what, we understand that these people are making this money. So forget that net number. Let's look at the gross. Let's look at bank statements. Let's see 12 months bank statements. We'll annualize a gross figure. We'll deduct a reasonable amount of expenses. And now that's your new income. Okay. And what happens is it's just changes what everybody qualifies for dramatically. It's almost easier when you're self-employed. However, you need a 20% down payment. Okay. Because those type of mortgages, are not insured. They can't be insured. So basically it has to have that 20% down payment to do that. Okay. And not everybody has the 20%. Now there's new programs we're going to talk about shortly in a second that can contribute or help you with that. But understand with self-employed, A lot easier to qualify income-wise. Just need that 20% down payment. Okay, so that's the other thing. And there are, the question is, if I'm self-employed, can I buy with less than 20% down? Yeah, you can. We can use stated incomes that are insured. We still need to have a history of at least 1 or 2 years of where that income is, and we can look at those ones as well.
So this next focus area is probably one I think listeners may not have heard much about. It relates to affordability as associated with down payment. Can you share with us a little bit about 2 programs that currently exist for home buyers who qualify, namely share equity homeownership and rent to own?
So I'll start with the rent to own, and I'll briefly kind of describe what this is. So rent to own. What is rent to own? Because, part of it is, when people are thinking, I want to get into rent to own, like, how do I find a rent to own property, a property that I can purchase and rent it and then own it? Things like that. So I'm going to kind of just clarify exactly what rent to own means and where people would choose that particular program. So for rent to own, it's basically you're looking to purchase a property, okay, that you're going to take over ownership down the road, okay, over a certain period of time. Could be 3 years, 4 years, 5 years, whatever that period of time is, okay? You still need income to qualify, right? So, because basically what we're going to do is we're going to say, okay, how much do you qualify mortgage-wise? So when you do take over the home, you're going to be able to take over that mortgage. So it's usually people get into rent to own. It's people with issues with shortage on down payment or credit issues. Okay, because one of the things that happens with rent to own is once you're qualified for rent to own, you say, okay, you're qualified for X amount. You go and start looking for a home, and it's any home on the MLS can be put into the rent to own program. It's not a specific property. Okay, so understand that you're qualifying for a program. It's almost like getting a cosigner involved. It's that sort of thing. Think of it like that. Okay, you've been approved. They've basically sponsored you, and you're ready to go. You go with your realtor and go find the home. Okay. Now there might be some conditions and stuff like that they put in. The realtor would be familiar with. But the idea is that, let's say I'm in a rent to own program. It's going to be a 4-year rent to own program. So I start off with very fractional ownership because I just have my initial down payment. Maybe it's 3%, 4%, 5%, however much I can put down. Okay. And then every payment that I make for that home, there's a portion that's going to help cover the carrying cost of the home. And then there's an extra portion that goes on top, which is going to cover my down payment that I'm going to accumulate over 2 or 3 years. And then I take over the home. Okay. Because I've already had the down payment saved over accumulation of payments. Okay. And the advantage is I already know the price point where I'm taking over that home, which is usually a lot less than the increase of the value if I just waited to save and then go buy 3 or 4 years from now. I'm usually saving a lot more money by going into the rent own because I've already kind of locked down that future value. Okay. So that's kind of, I'm going to park that one. That's kind of where that would work.
Can I ask one quick question?
Yeah, go ahead.
Just related to rent to own. So is there a particular price point or is there a maximum range in terms of purchasing a rent to own property?
Yeah. So rent to owns, generally it's going to be properties under $1 million. Okay. So once you get over to $1 million, over $1 million becomes very, very complicated and costly. And it's probably, especially, and if you get into pockets that are kind of outside the GTA area and everything else where, I'm going to talk about shared equity in a second, where areas that shared equity wouldn't cover, then rent to own would potentially be the next viable option to help you get into a home sooner.
Okay, awesome. Thank you.
My pleasure. So the next one, shared equity. Okay, so shared equity financing I would say is pretty brand new off the press. So OFSI had come out. So OFSI is the governing body that sort of oversees all the financial institutions, recognizing that it's getting harder and harder for people to buy homes. And what happens is we often, we're almost like we're chasing the pricing and then all of a sudden we feel priced out of the market, so we're sitting on the sidelines, right? So what happened is they approved a program called, basically it's shared equity financing. Some people will call it co-ownership financing, but I'm not really a big fan of that term because it sounds like Nicole, you and I are going to go buy a home together and co-own it together. And that's not what this is. So I like the shared equity financing. And basically what it does is it gives you what you need to have a full 20% down payment. Okay. I, as the homeowner, have to have at least 5%. So 5%, and I can buy up to 1.7 million with as little as 5%. So it's great for homes that are over $1 million, even under $1 million. The minimum purchase price has to be, say, $570,000. But it allows me now to get into a home it'll elevate my purchasing power. Let's put it this way. So I may have a couple that might come in and say, hey, listen, how much do I qualify for? And I might say, you guys qualify with your existing down payment, maybe for $650,000. Or if you use the shared equity financing, it could be $850,000. Okay. So it definitely boosts how much you're qualifying for, because basically what we're doing is we're going to figure what's the maximum we can qualify you for at a 30-year amortization, because there's 20% down, and we're going to add 20% down payment on top of it. Now it's going to be your new purchasing price threshold. Okay. Now you're obviously, so what happens is there's no payments that you have to make. There's just when you sell that property, you have to pay your equity share of that increase or decrease back to the co-ownership or shared equity entity. Okay. And I don't know if you want to get into all those details right now in terms of what that is. Maybe we can save that to another one. I think it's probably just important to know that, especially with this particular option, a lot of people are saying, okay, how much do I qualify normal? How much do I qualify using this? And then we're able to work on making a decision in terms of which is the best, most suited to figure out, okay, where do we want to be in 3 or 5 years from now? And if it's using this program to get into a home today, to start building equity, it's helped a lot of people do that, right? Exact thing. Because otherwise, if I was waiting 3-4 years to continue savings, that price point that the house I was going to purchase is like, X amount more now or down the road. I'm still chasing the purchase price and having the amount of down payment that I need and everything else. So shared equity, brand new. I'm a big fan of. So when people come to our world, we do look at the other options first. If we can get gifted from down payments from family members, things like that. But not everybody has access to that. And then we do a calculation and say, okay, using this program, where are you going to be in 3 years from now, right? And then how much money now, if you go sell this home 3 to 5 years, how much are you going to have in your pocket now to go buy that next home, right? And it's a lot more than if I was just trying to save money and rent at the same time.
No, Lorne, this is excellent. It's the beauty of it. And I think, yes, providing people with knowledge that this type of program, or listeners know that this type of program exists, I think is critical. And we should definitely address this in a broader perspective, in a more deeper perspective at a future podcast. So if I can wrap it up, Lorne, down payment, income, credit score are integral in determining the mortgage you can support and the actual value of the property that you can purchase. Working with someone who can guide you through the steps and help you strategize. So as Lorne was talking through some of the examples, he talked about the strategies that he himself and the real estate agent was able to help the client to see what options were available and what strategies they could implement in order to achieve the goal and make the best path forward. So whether it's a conventional purchase or using alternates of shared equity at home ownership, there's something out there for you that can bring you to home ownership sooner than you think. Like what you hear? Don't forget to follow the podcast and leave a rating and a review. Please forward this episode to one friend. If you have suggestions for future topics, let me know. Thanks for listening.